Wednesday, August 30th, 2023, Monaco 64, home of alternative economics and contrarian views. Today, we're going to look at why the markets are clamoring for Fed accommodation, and that's my opinion, of course. It just feels like anytime you get a slight hint of weak economic data, the market goes wild, and I think that's a bad thing. I think it shows that the market is addicted to whiskey or whatever they're putting into the market, right? The central banks. I know they've raised rates quite a bit in the last 18 months. But be as it may, I think things are still accommodative as they are. What we're going to look at today as well is some very interesting charts of gold and silver, long-term charts, and one of them is probably one I've never talked about, and it's a kind of technical analysis that I learned from Jim Sinclair when he used to keep his blog, JS Mindset, and I followed that pretty much since when I started buying gold and following gold in 2002, and it was very helpful. So we're going to do that. Before we go on to the markets and how I feel that it's clamoring for this, for the Fed to stop. They want the Fed to stop hiking. They want the Fed to cut. And I think the Fed might have put itself between a rock and a hard place, not just the Fed, but also the Treasury and the government with their shenanigans. To do with the statistics, of course. Just wanted to say that, yes, if you're still on the fence about buying gold and silver, well, give ITM Trading a call. Talk to their team about their strategies for wealth preservation. They can help you. All the details are below in the description. If you don't need that, you can just go straight ahead and buy gold and silver, let's say through Miles Franklin. I'm affiliated to them as well in North America. Here in the UK, Gold Investments, of course, they're there all the time to help you if you need any help with buying gold and silver. And of course, I also have Glint, which is kind of a different way of buying gold. They keep it in an allocated account at a private vault in Switzerland for you, and you can have an app, and they provide you with a debit card, not in every country, and you can spend with that debit card. You can spend gold. So back to the markets and the economy. There's been a lot of talk recently about the fact that the BLS, the Bureau of Labor Statistics, has been revising old jobs data. And another thing as well, I said earlier this week that the jobs data was going to be next week, because sometimes if the first Friday of the month falls like on the first of the month, they put it forward. But I just realized that it's actually coming out this week, non-farm payroll. Today we also have preliminary GDP. GDP works that you get advanced, preliminary, and final, and it's for the second quarter. But as you can see here on Twitter, David Brady at Global Pro Trader, he tweeted yesterday, how wrong can one be about such an important data point? Pump the numbers and revise them down later when no one cares. That doesn't appear to be working. So this was from August 23rd. And I think he did a screenshot of a story on Zero Hedge. U.S. jobs are about to be revised by 650,000 lower. The gap between the estimated level on the QCEW and published NSA NFP is close to 500,000. Well, that's what they've been doing for many decades. They manage perception in the market. They're trying to keep markets, stock markets, bond markets elevated. And why is that? Well, because the people at the Fed, at the Treasury, they have this belief that if asset prices are high, it creates a wealth effect. But it really only creates a wealth effect for the top 1%, maybe the top 10%. But we've seen Fed data about wealth distribution. It's been getting worse and worse for the bottom 90%. And the Fed, contrary to popular belief, when Jay Powell gets up there, the chairman of the Federal Reserve, and says they're doing everything to help the average American in Main Street, he's not really being, I would say, totally honest with people. He's out there to help the top 1% or even the top 0.01% of which he's part of. The people who are the big holders of or partners in the private equity groups, the hedge fund moguls, all these kind of people that probably own about 40% of all the wealth, the top 1%. He's trying to keep that from collapsing. He's trying to keep the fiat Ponzi going. And that's why they do that, along with the Treasury, along with the regulators like the SEC, the CFTC. And that started out in 1987 after the crash in October, when Greenspan had just taken over. And they decided to form the Working Group on Financial Markets, more commonly known as the PPT, or Plunge Protection Team. And that's been going on and on and on. But nowadays, people are waking up to this, and we've got social media. And it does matter a year later that they see that all these numbers have been doctored. And it's very easy to doctor non-farm payroll because it's a survey. So they can decide to put anything out there. They don't go to each company in the US and say, how many people did you hire? No, they just do a survey. What that has done, of course, for the Fed is that they've had to pretend, yes, the economy is doing great, labor market is tight, so we have to maybe raise rates or keep rates elevated. And at the same time, though, the market has remained fairly steady. But then when you get data like we did yesterday with the JOLTS, it's job opening data that drop, and we also saw consumer confidence drop quite a bit. Yesterday, I think consumer confidence was a lot lower than expected. Then you get these moves in the market. You get yields, treasury yields come down like they did yesterday. If you look here, I took a screenshot. The 10-year dropped 10 basis points to 4.11. It's almost as if they want now the numbers to be weak because we're approaching some key levels in the bond market, and they didn't want it to go higher. And why is that? Well, because it's going to hurt the financial markets. It's going to hurt the Treasury because they've got loads of debt to issue. They're borrowing like crazy. They're deficit spending. And the other thing is that Wall Street plays right along with it. They don't say, oh, this is rubbish. They keep revising the numbers. No, they play right along with it because they don't care really about the economy. They care about speculation in the markets, stock, bond markets, derivatives. That's how they make their money, while the real economy continues to deteriorate. So Yeah, that's what it's all about. It's a management of perception. Yes. And I think the markets, they're clamoring for some kind of accommodation from the Fed. Will we see it? It's never clear, or you can never predict markets, but gold and silver might be pointing to it. And why is that? Well, because they're approaching some really key levels on the upside, and if they break these key levels, it could be an indicator that the Fed is going to accommodate. And why? Well, something's going to happen, and it's going to trigger some kind of accommodation. And the other thing is politics, isn't it? It would be good timing for things to kind of hit the fan in the next few months, and then the Fed comes in, helps everything just in time for the 2024 election. So I told you I wanted to show you some charts of gold and silver. I'm going to start with the silver one, and it's a very long-term chart. It goes back to, let's see, 1987 actually, and it's a quarterly chart, but it shows you why this area here around 25 and 30 has been so important, or at least 25, 27 in the last year and a half is so important, because if you look at the top in 2011 and the top at 30 back in 2020 and 2021, there's a trend line coming through there, and it looks like we're starting to break out of it. And so right now we're just above 2450, I think. Let's have a look where silver is. Yeah, we're at 2460. And we've got, of course, today and tomorrow till the end of the month, August. And the level that I have on a monthly basis that's really important is 25, I think, or thereabouts. So I think it's looking pretty good. It looks like it wants to break out. It's broken out as well of another little falling wedge there, as you can see. And if I go back further on this chart, we've got, of course, the massive teacup and handle that's been created from the high in 1980 at 50 and the high in 2011. Another reason why the level around 26 and 30 as well are so important. So what this is showing me here is that, yes, the Fed and other central banks could be ready to accommodate policy for whatever reason. And it could be a recession upcoming. It could be some kind of geopolitical crisis, some other kind of crisis like we had it in March 2020. They could come up with whatever they want to justify keeping the Ponzi scheme going, because, as I've been saying forever, when you solve a debt problem with more debt, you can't stop. And that's what they've been doing since '08. So now to the gold chart, and I think you'll find this one interesting. I said that I used a technique that Jim Sinclair used to talk about, and it's the French curve. Well, you can try it on TradingView to draw French curves. I did that. You might not believe in it, but I think it looks very interesting. This is, of course, another quarterly chart. This one's for gold. I started out in 1968, and I say here French curve for XAU USD or gold quarterly since 1968. Well, 1968 is important because it's when the major treasuries of the world, major central banks, the G7, lost control of the price. Up until then, they'd had this London gold pool since the early 60s to keep gold below 35 or at $35 an ounce, because that was the Bretton Woods fixed price. And why do they need that? Well, because the U.S. was starting to kind of cheat. The U.S. was printing more currency than they had gold backing for it. So it broke this peg, so to speak, the London gold pool. And it wasn't a covert thing, it was overt. People knew about it. So that's why I think it's important. That's when the price in the international market in London started moving higher. And you can see that I said here, the further along the curve, the wilder the action gets. And you can see how from around 2005 or 6 there, the price of gold took off from that curve. And it went up all the way to 1900 by 2011. So it can get away from that curve for a long time. Yes, it blipped down back in 2008 there, but it didn't even get close to the curve. So what I'm trying to say here, it looks like it might not go that high, but it could get out of whack for quite a few years. So I think this is very interesting. And you probably heard that there are different kinds of bull markets. In financial assets is to do, stocks and bonds, it's to do with greed. In commodities, a lot of times it can be with greed along with financial assets, but it can also be to do with fear. And fear is an even stronger emotion, I would say, in markets, because, it's usually related to wars, pandemics, and also currency collapse. So who knows what's going to happen? Is this the melt up coming? Is this the collapse of currencies? And hence we could see people pile into gold and silver out of fear, or the melt up. They'll pile into everything. It's all up in the air. And all I can say is that I'll keep hold of my gold and silver. I have actually gone back a little bit into the miners because I'd been out of quite a few of my positions for the last six months or so, and I've added on to some of the silver miners because I think silver could outperform gold, and and that's it. So let's look at where the markets are then this morning. It's 8:26 a.m. London time. We've got spot gold, 1935 is down a couple of dollars. High's been 39 and the low 32.50. And I think if we're able to close above 1965 by tomorrow, I think that would be very bullish on a monthly basis, on a weekly basis as well. And for silver, I think the level there is going to be around 25, spot 25. Right now, silver is down 14 cents, 24.57. It's down 0.5%. The Dow futures is down 22. The Nasdaq is down 23, and the S&P is down 5. To the currencies, sterling is down about 0.2 at 126.25. The euro as well, 0.2 down, 108.59. Dollar's up almost 0.5% versus the yen, 146.47. Dollar's up 0.25% versus the yuan at 7.30. Let's look at the good old ruble. Yeah, the dollars continue to creep up. We're now at 96, up 0.2%. The Aussie dollar is down a third, 64.56. Dollar's up 0.2 versus the Canadian dollar, 135.74. And the Kiwi dollar is down 0.5% at 59.35. WTI crude is up 0.5% at 81.50. Brent is up 0.5% as well at 85.25. Platinum is down a couple of bucks, trading around 977, and high-grade copper is down 0.25% at 383. U.S. Treasury yields have ticked up a little bit after yesterday's big drop. And I think also the market is yesterday eliminated kind of the probability of a hike in September by the Fed. Right now, the 10-year is up 3 basis points at 4.15. And we'll finish off with the UK market. We've got the 2-year yield up almost 10 basis points at 5.32. So that's not a good thing. A lot of mortgages in the UK are fixed for 2 years and 5 years. The 30-year yield is at 4.71. It's up 7 basis points. So there you go. With that, I'm going to wish you all a very good day. Take care. Bye.